Okay, so I think we're ready to get started. This is the innovation panel, in case you're wondering whether you're in the right room. I'm the chair, Kingsley Jones. I'm a research fellow at CIFR. We have an absolutely wonderful collection of panellists here today to discuss innovation and how this relates to, obviously, the financial services or financial system inquiry. Certain recommendations have been made. We're not going to slavishly address those in the bulk of the hour. We might do that towards the end, I think, because the most important thing that I want to do today is have us all learn from each other, as it were, but particularly from the panellists here, about how regulation, technology, law, entrepreneurship interact in real life. And in particular, if I had to provide a thought, we've heard the analogy of the motor vehicle from Kevin earlier, and I think it's a great one. I myself have spent a lot of time in financial markets as an investor and trader, and oftentimes, the best intentions of rules can fall by the wayside when the rubber hits the road of real market action. And as Peter indicated in his talk, Peter Mason, a great example of that was the GFC. I can speak from personal experience. I was at that time working on the trading floor of Macquarie Bank, not the banking side of that institution, but the actual investment side of the institution, investing client money as a portfolio manager. And on that particular day, and this is not commonly reported, but on that particular day, our trading desk went into crisis because our counterparties wouldn't deal with us. This is on the investment side. And if you've run an investment fund, you'll well appreciate that the money is there. There's no doubt that there's money there backing the trades. So when you have a market condition where your counterparties refuse to trade with you, and those counterparties are actually US banks, which are themselves in crisis, then you begin to realise that this is all pretty serious when it gets down to it. So the government supporting our markets in that event had very practical consequences for my own job. I managed to keep my job and I managed to continue to trade my client portfolios. So, this stuff actually is pretty important. And with that in mind, I think, again, drawing on my own experience as an investor, I've had a look at the report. I think it's a great report. And the guiding thought for me in assembling the panel today was to, really reach out to people from different aspects of the financial community, but particularly those who are at the coalface of trying to maybe bring a new business model to market. We've got some excellent entrepreneurial representation here, and I'm very keen to hear their views about how we actually manage some of these issues of change in the system. We have some very fine legal minds, and also folks who have deployed that legal thinking in active practice of regulation and therefore have encountered many of the issues involved, and also some folks who are in the early stage investment area or have been deeply involved with the formation of new companies, not only here in Australia but also overseas. So I think that's a great background for addressing our key topic, innovation. But before we do that, there's just a couple of little things I need to get through, and then I'll introduce the panel. Firstly, in searching for a thread that runs through all this, I think for me, philosophically, what's most important is maybe to have an understanding that our regulatory system really needs to have, I think, three qualities that I'd put forward for consideration. One is that the system is engaged. Interestingly, a word that popped up in one of the submissions about having an engaged regulator, and what exactly that means. Having an adaptive system, and I don't just mean the regulator, I mean actually the body politic in general. Is this inquiry document going to land on the desk of the present Treasurer and then there is no adaptation in terms of policy as a result, or are we going to actually see engagement and adaptation on the part of those who make laws? And then finally, and most importantly, and I want to pick up on something that Ken Davis was really alluding to in describing the philosophy of those assembled to conduct the inquiry, and that's grounded. I think one of the great things about being Australian is we're very pragmatic at heart. Sometimes we're a little bit slow to really step up and take on these difficult challenges of forming new companies and rebuilding the economy, but I think we're all pretty grounded. And so those three things is what I'd offer is where I'd like to get to in terms of how this panel deals with the challenge before us. So, firstly, one little nicety. We have about 1 hour and 40 minutes. What I propose to do is we'll run it essentially in 3 pieces. The first bit, and in each of these pieces I'll get the individual panelists to maybe give a 3 to 5 minute pitch. I want us all to hear their 3 to 5 minutes on what they are most interested in. But we'll try to organise that in such a way that it's not too clumsy. I would like, firstly, we might draw on those who have the legal and regulatory background to talk about, if we will, the philosophy. What happens when law meets technology meets regulation in real life? And so I'm thinking particularly Ross and Belinda can maybe speak to that. For each 3 to 5 minute pitch, I think it's desirable if we at least have the opportunity to interact off the back of what each person says, and then, you know, have in mind that the audience may have some questions. So after each 3 to 5 minute pitch from a speaker, I'd ask it, maybe we as a panel, you know, bounce around some ideas off that. Might have a little bit of Q&A and we'll move to the next one. But the basic structure is, in that beginning, we'll talk about the philosophy. In the middle, I think it gets interesting. We have a number of entrepreneurs here, and I'd really like to talk about the practical business of disruption. I think there's a lot of folks in Australia, particularly in the press now, who you know, been drinking the disruption punch and think it's really cool to disrupt things. But of course, when the disruption gets disruptive, then other people tend to push back, and you can get a little ugly. In a good way, because that's part of the social change. And I want to hear from the various entrepreneurs assembled as to how disruption can be disrupted and where they are noticing in their own businesses that where they would like to go for the customer is already interacting in the regulatory system in a way that maybe indicates some future change. And then at the back of that, I think we should have had enough discussion that we can move to maybe some of the broader social issues that come with you know, the new world of work, finance, and what it is we're trying to accomplish, and have a sort of broad Q&A. And finally, I would like, if we could maybe do our homework, and we'll go through the list of recommendations and just bounce ideas off one another, so we've got a little bit of material. So that's a lot to get through. One other piece of housekeeping. These little microphones that you see, they're all pressed to talk, a little bit like walkie-talkies. So, you know, it's a little bit like the conch in, you know, Lord of the Flies. When each of you want to give you 3 to 5 minutes, I'd ask that only one of you actually presses that button. and that's your time with the conch when you get to talk. And similarly with the audience, please, this is meant to be free-ranging, just put your hand up or motion to me, and I as a chair will attempt to include your question, and the same goes for you. On each of your tables there's a microphone and you can press that little button to have your say. Okay, so that's a very long-winded introduction. Now to go to the panel, in no particular order, starting from Ian Upperman at the end, CEO of Rosetta, formerly with the CSIRO, very deep experience in big data, and Rosetta is a firm that's really making some waves on how to process these ginormous data sets. So very interested to hear what Ian has to say. Belinda Gibson, surely known to many of you in her role as Deputy Commissioner at ASIC some years back, very distinguished legal career, and now an independent consultant. I hear occasionally having a good chit-chat with Microsoft about what they might do in this space, so plenty of ideas there. Jost Stallman, who has a very distinguished career in German politics that a lot of people may not realise, until he got on a sailboat and wound up here, and then eventually founded, well, didn't found, pardon me, participated in helping establish and grow Tyro Payments, which is you know, the real challenger organisation in the payment system up against the big banks. And to my right, Professor Ross Buckley, professor at UNSW, a law professor, has done a great many things in research, but has contributed to, particularly, I thought, interesting for this panel, some of the legal innovations required. People don't often think of lawyers as being creative. But hey, you need some creativity from time to time. particularly when Africa decides to leapfrog the development of a banking system and go directly to mobile phones as their preferred currency and pay in minutes. So Ross has been involved in that. Stuart Stoyan, another entrepreneur, CEO of Moneyplace, some views from the coalface. We'd love to hear from him about peer-to-peer lending, what it all means. Sandy Plunkett, consultant, spent a lot of time in the valleys. If you get to buttonhole Sandy later, I mean, do have a chat. She's got some wonderful stories about folks who are, I guess, big names here, but not many people know people who know them and have seen what's happened in that very interesting hotbed of innovation. And then last but by no means least, Ben Heap, CEO of Australian Wealth Investments, has been, I think, with UBS Global before, is that correct? Yes. A professional investor, I think, would be the best way to describe Ben, but particularly in the innovation space. And, you know, AWI is one of those organisations which is really advancing the cause of bringing innovative new business models to market, and they're an active investor in a whole range of financial service startups. So that's a lot to get through. So again, please do raise your hand in the audience if you have something to say. We'll do our 3 to 5 minute pitches now in that broad sequence. And to kick off, we might actually start with Ross Buckley.
Okay. Thanks, Kingsley. Thank you very much. 1963 in England, a builder walked off a building site into a recording studio and a rock legend was born. The builder was Joe Cocker. He died last year. 2007 in Kenya, a telecom executive was walking to work one day and he had the idea that, well, we can track airtime. We sell airtime by seconds. And we know in real time how much airtime each of our customers have, and they're trading it with each other. And we sell this airtime through agents, little stores that sell tobacco and Coca-Cola and junk food and airtime to telco customers, mobile phone customers. So people can go in and buy an airtime and top up their phone, or they could go in and buy e-money. They could go in and buy electronic money, put that on their phone and use that for all sorts of useful purposes. And so it wasn't a rock legend that was born, but it was a financial revolution that was born. It didn't really start in Kenya, it started in the Philippines and other places before that, but rock and roll didn't start with Joe Cocker. And I don't know whether it's going to die or not, and I don't really know whether it's going to take off in Australia, but it's what I want to talk about today. Digital financial services, and particularly on what's happened in developing countries and where it's worked and where it hasn't. When Joe died last year, my wife said to me, gee, he wasn't very old. People normally live longer than that. I said, if you saw videos of him performing in the 70s, it's a medical miracle that he got as old as he did. But anyway, in Kenya today, something like 80% of adults have a mobile money account, have an e-money account, which is an extraordinary degree of penetration. Small business entrepreneurs running tiny businesses use e-money on their phone to pay their suppliers. People use it to send money back to the village, remittances back to the village. The government is extensively starting to use it to make welfare payments and other payments. And the take-up has been quite extraordinary. And no doubt part of the reason was the need was very, very high. There was a great deal of financial exclusion. Most people didn't have access to a bank account. If you worked in the city and you came from a village, the way you got money back to your family was you put it in a brown paper bag and gave it to the bus driver of the minibus and he'd drive it home. And even though mobile money is expensive, the bus driver was more expensive because culturally he'd take the view that if he got hungry on the way, he could take the money out of his bag. The bag is fair enough because I'm hungry or the bus needs some petrol or whatever, so it was expensive. So it's really taken off. In other parts of the world, it hasn't taken off. It's done moderately well in the Philippines, it's going pretty well in Peru and Brazil, but in some countries it has not gone very far at all. And this is a huge question. Why has these really innovative, disruptive payment system taken off in some and not others? And a big part of the answer to that, I think, is innovation, is regulation, rather. And frankly, regulators staying out of the picture. Because in India decided, about the same time, that it really wanted to see this, because welfare payments in India, 6 or 7 years ago, roughly 45% would go missing. Now that's a chunk. That's basically corruption. The Indian government puts other names on it, but it's corruption. If you're in a country like India, if you're relying on paper payments and receipts, 45% goes missing. Right? If you pay it over mobile phones, you get an audit trail, you can police it, you know, it offers wonderful benefits to the government. So the government said, we want to do this. And they didn't, the Central Bank of India didn't change any of its regulatory settings. So in 6 years, they went absolutely nowhere. And it wasn't until they really changed their regulatory settings that it's now sort of starting to take off. Whereas in Kenya, basically, the regulator just looked the other way, left Vodafone alone. Vodafone decided for commercial reasons to stand behind it, the same way banks stand behind credit cards. And so it worked. So if there's a lesson from this, you know, law meets technology meets regulation, is that I think regulators in this space, particularly the micropayment space, need to be willing to stand back for a while and watch it evolve. In terms of disruption, these mobile sort of payments are going to be very large in America. I've got absolutely no doubt about that. The new Apple phone has got contactless payments, the Android phone has got contactless payments. America has a big financial exclusion problem. Lots of Americans can't get a bank account. You combine the absence of a bank account with the convenience of contactless payments, and it's very clear to me that what's happened in developing countries will roll out in a very big way in America in the next few years. In Australia, I'm not so sure, because most Australians do have a bank account and because we lead the world in pay wave, tap and go. So I'm not so sure about Australia. I am very confident about America, and I will hand over to Belinda. That's easily my 5 minutes. Thank you.
Thanks, Ross. I thought I'd talk a little bit about high-frequency trading and how the regulator responded to that, because it's in a way it's light touch regulation, but it's a circumstance where there is a need for regulation, and that's what everyone wanted. High-frequency trading is use of computer algorithms to bombard a market system with buy and sell orders at very, very fast times. I think it's 0.001 of a millisecond. Orders can be placed in and out of the market. It accounted for some 70% of trading in the US pre-GFC. It's now, I think, down to about 50% for reasons I can't explain, but it is. Government, Chris Bowen said that Australia would have competition for the Australian Stock Exchange with another exchange in 2009, and that ASIC would have to take on supervision of that market. So ASIC would have to have the people in the dark rooms with the screens monitoring trading, looking for insider trading, looking for market manipulation, looking for market divergences that needed to be dealt with. It's a computer real-time system. In 2009, the US was starting to get concerned about the enormous amount of high-frequency trading. There are academic articles that say that it was the fault of the regulation that arose. I don't believe that. I think it's more sophisticated computer technologies, more agile computer technologies, that is, that there are more people who can program more computers more readily to do more work much more quickly. Whatever Moore's law is, which is about capacity, also applies to speed. So it was a rise of a facility to trade. You've also got a rise in the common availability of exchanges. An exchange, after all, is really, these days, just a computer system. We have regulated exchanges that have a whole regulatory role in managing the system. And you have more opportunists, I think it'd be fair to say. You have more people, some would call them innovators, who see an opportunity with the manner of trading to make a quid on the turn. And to continue the car analogy, I was in New York with the head of our markets area, Greg Yanko, and another fellow, and we were about to cross, I think, about 52nd Street, and one had made it to the other side, and I was there with Greg, and he said, I'm going to explain to you high-frequency trading. There's Chris over there, and he's got a buy order on. You, Belinda, are here. You've got a sell order. In an ordinary market, you would meet in the middle, and off you go. You would have a trade, and that would be that. The high-frequency trader is that taxi coming very fast down that road, and he is going to leap in the middle, take out Chris, and deal with you more in the middle. That's what high-frequency traders do. In a traffic jam, in a traffic jam, the cars don't move so fast, but part of the art of high-frequency traders is to create a hell of a lot of movement, a hell of a lot of, more like dodgem cars, I think you'd say, where you place a lot of orders, remove a lot of orders to create confusion. There's a heap of academic debate as to whether high-frequency trading is good or bad. It's interesting, and the high-frequency traders use algorithms to try and make an assessment of where the trading flow might be going and how they profit from that. The academic research, I think, says that the volume and the liquidity that high-frequency trading brings to the market is good for the overall market in terms of efficiency, which is all about lowering the spreads. That is the taxi taking out. The spread would have been between Chris and I. The introduction of the high-frequency trader removes the spread to me, to the taxi that's slipped in the middle. But you have to accept there are times when there's a traffic jam and everything stops. There are times when high-frequency traders just remove liquidity from the market, and they tend to do it in periods of high volatility, and that's what causes some of the market crises that happened in 2010 and so on. So what did ASIC do about it? Once we got market supervision done and we had a very sophisticated system to looking at the order places in the market and the orders in the market and what was happening, we were in position to do our own analysis. We went back to the US in 2012 and there was very, very serious anxiety about the rise of high-frequency trading and the existence of so-called dark pools where institutions thought they were trading without seeing the high-frequency traders and not really, which effectively are the big banks' private exchange networks. And it was becoming clear that those big banks were making a lot of money by letting retail and institutions in there, and the high-frequency traders were acting there. We started a very active discussion here about those marketplace problems, which were of a low order in this market because it wasn't very sophisticated. The ASX picked up on it, perhaps with some vested interest in trying to get the regulator to shut down dark pools, which are competitors for the ASX's market and the ASX's own dark pool. Institutions picked up on it because they felt that they weren't being able to trade fairly in the market, that others were getting some sort of advantage. There was a lot of talk about market manipulation, which frightened retail investors, and really the system was grinding to a circumstance where you had to be concerned about a lack of confidence in the system simply because of uninformed discussion about these elements which were huge problems in the States and to a lesser degree in Europe. I think they were huge problems in Europe, but no one even had any idea they existed in Europe. So what did the regulator do? We spent an enormous amount of time with all of the financial market players, the sophisticated players, the institutions, the exchanges, the dark pools. We talked to a lot of other regulators. We did our own very, very detailed analysis of what the trading was in the market, relying on the system that ASIC had, released a thought piece that did some analysis in our market, and again it showed that it was very early stages, and released a number of rules which were designed to stop some of the bad behaviour in the dark pools, but also to get more visibility and link the markets. So I think, why do I go into this detail? It's technology, it's disruptive. The high-frequency traders, you would say, were disruptive literally because some of their activities would disrupt the market. But I think it reflects a regulator that had some of those attributes that you were looking for, Kingsley. Engagement with the whole of industry, flexibility of the whole of industry to respond, that this was something where all as industry thought there's a problem and we need to find a solution, and regulation is the solution. And there's a lot of talk about deregulation, but actually it's more about the right regulation. And in that top end of traded financial markets, it can be reasonably heavy-handed. As it came up, we came up with fairly simple rules. I was reading that the rules, there's a thing called Reg NMS, that is the US rule that is said to have created the foundation for high-frequency traders to go wild. Reg NMS runs to 500 pages, if you please. So bring on the lawyers. But it does mean that there's very limited regulation. So just touching briefly on one more aspect. Historically, all exchanges have detailed supervision computer systems that are bespoke for exchanges. They're fairly slow, fairly clunky. Dare I say, they perhaps haven't moved with the times in terms of market changes. ASIC engaged a crowd called First Derivatives to write the new market system that went in place 2013. First Derivatives, the big arm of First Derivatives are high-frequency traders, that they are algorithmic rhythm traders, and they have designed technology that the regulators can pick up and use to have a system that's much more flexible, much simpler, much quicker. And in fact, I gather all of ASIC enforcement division and supervision are using that in their role. So again, we shouldn't think, we should think that an ASIC or another regulator is an important part of the system, but I think that demonstrates a capability to use the system also.
Thank you to both Ross and Belinda for that. So before we move into a discussion around the entrepreneurial dimension, I thought it'd be great if we could just engage with the statements we've heard from both of those speakers in this theme of adaptive, grounded and engaged regulation. Firstly, I thought what was most interesting about what Ross has shared with us is maybe there's some merit sometimes in having a disengaged regulator, or rather a regulator who's engaged but not adapting in the sense of trying to stop things, but adapting in trying to understand what's going on. So we might explore that in a minute. Absolutely. And then the other thing that I wanted just to share before we really open it up for discussion is something that Ross touched on, which is he made some really interesting comments about, say, the difference between marketplaces in their likely adoption of an innovation like mobile payment systems. And he pointed out that having an underserved market, like banking in the US, where there's a lot of people who are disenfranchised and excluded from the banking system, and certainly in Africa, can be an important thing. And the other thing that I would say about that is, I think it's really important, I'm putting on my investor hat, if there's a large profit pool that already exists, which could be displaced or attacked, if you will, by an entrepreneur with a new innovation, then obviously that's a prime game. But there's also recognising where there may not be currently profits being generated because simply nobody's stepped up to the plate to figure out how to deliver banking in a place like Africa. And then you've got very mature markets like in the US, where those who are not familiar with US banking, I myself have tried to open US bank accounts, and I had no problem opening a personal bank account, stepping into a bank in Manhattan, but I had dreadful trouble opening a corporate bank account. So it's a very, very fragmented system, and when you have that fragmentation, then it's possible to have these sorts of innovations. So let's open it up now. Anybody on the panel like to pick up? Yes, please, Stuart.
I thought But Linda's framing of it, saying it's about the right regulation, is exactly right. And this sort of goes to your comments, Ross. In Kenya, the example is the right regulation is to get out of the way. And this is the challenge that I've experienced personally in launching a peer-to-peer lending business, but also just generally in an observation around the regulatory environment in Australia, is it is very much a reactive environment. And so what you want some degree of proactivity. You want an ability, and this is sort of where you have that graduated approach to regulation, enables you to be able to put guardrails in place and say, we don't actually know how to regulate this space. We have an idea, it could be this, it could be this, maybe it's this regime from 20 years ago, but we're not kind of sure. And so instead of trying to sort of square peg round hole it and fit a regime that was sort of built 20, 30 years ago that didn't consider some of the technology aspects of today, to be able to put guardrails in place and to be able to then actually enable a new industry to be able to run and then regulate it as you go. Now that doesn't mean that it's unconstrained, that doesn't mean that you can go out and do whatever you want, but with sort of some limits and controls in place. And I think the important thing here as well is to distinguish between a graduated approach to promoting innovation and also having a reaction where there are bad actors. Of course, where there's a bad actor that's unreasonably profiteering or taking advantage of customers, then absolutely that should be regulated.
Thanks, Stuart. Jost, I think you had something that you wanted.
Yeah, I'll probably take ownership for the coining of the Engaged Regulator. When I came in 2004 to Australia, I met Ian McFarlane. John Lakers was at APRA. And I perceived them, by the way, as engaged regulators because they were obviously always concerned to maintain the safety of the system and to discourage abusive behavior, as much as they were then also wondering how they could enable innovation and competition in an environment that was dominated by major banks, and they didn't perceive that the banks had been very good at it. That's the only reason why I'm sitting here. We always call ourselves the birth child of the Reserve Bank. It's a very unusual situation, I must say. Now, 11 years, I still try to think I'm the new entrant and the new kid, but it's 11 years that I'm the new entrant and the new kid. I'm still the only one. I'm actually quite perplexed by the reality. To what extent major banks just have this culture of testing and being successful, what can I get away with? That's amazing to me. Just a short field report is that the regulatory goal was explicit and is explicit. Provide Australians with a financially safe, efficient and competitive payment system. I'm focusing on payments, that's where I am. The public interest requires a balance between fostering innovation and competition while mitigating the risk to the financial systems. Who would argue with all that? So the undertaken regulatory reform at the time sought to restrain abuses of collective setting of bank interchange fees, first. Second, to allow retailers surcharging of actual costs. And third, to eliminate access barriers for new entrants. We were particularly concerned with that aspect. By the way, you can read the history nicely in the last consultation paper that the Reserve Bank published recently as a consequence of the David Murray report. It's a nice history of my experience. So the regulatory intent and the outcomes were completely, even for me as a German country boy, it was completely clear. The industry could have gained trust by delivering those, or could have lost trust by undermining them. In my opinion, they chose the latter. They undermined those objectives. Let's just quickly revisit the three as proof points. The global schemes, my friends, the global schemes, the four major banks and the two big retailers, they actually gamed wonderfully the game. It's described in the RBA consultation paper. You can read it there. And they massively proliferated the payment cards from 11 different card products when the reform started to 72 now. So visibly we need 72 different card payments. Why did they do this? because the resulting complexity allowed them to massively overcharge interchange fee between the regulatory review points of the Reserve Bank, who had set the average to 50 basis points. I mean, it's stunning how smart they came. They also charge medium and small companies through the gaming hundreds of millions more than they charge to the big retailers. And they charge hundreds of millions more to the low-income cardholder that subsidizes the high net worth individual. Fabulous system, and to throw into the mix, they then launched the companion cards with Amex, which allowed to have an interchange fee that wasn't called interchange fee because then one could have thought it falls under the regulation, to further nurture their lavish interchange income. For me, this is an absolute scandal. Now, the David Murray report fortunately raises the issue of the interchange fee. It's overdue to allow, in my opinion, an Australian to access with his debit card his own money without any penalty of an interchange fee. The interchange fee has to be zero. And to allow credit and charge products the access at an interchange fee that reflects that today card payments are a ubiquitous way to pay. This is not new land, and it should be set at 30 basis points as foreshadowed in the older years by the Reserve Bank, or set it even lower, but certainly not beyond 30 basis points, and architect it so you limit this fabulous gaming. So that was one of the objectives. Another objective was, let's give choice to the consumer, let's have transparency at the point of sale. Now, what do you think did they achieve with 76 useless card products and all this complexity? Well, they achieved that there is no more transparency, and also the ability to surcharge, unless it is excessive surcharging, is not possible. This continues with contactless, there is no more choice, and with named account approach, in the future, the merchant cannot see anymore what type of card product, for what cost he is accepting. He's totally in the dark, and the card holder has no more choice. Here, my suggestion is, how come that schemes and banks launch products in the market and specify them technically to completely undermine the regulatory intent that was clearly stated? No, they should go and make sure that they actually deliver, and technology is there to do that, actually. They shouldn't argue that this is too hard and impossible because they are such innovative, wonderful companies, as we can read it in their marketing material. So the third one was access. That's very dear to my heart. Complete, utter failure. If a new startup wants access to the core payment system, it's not there. The access is completely, totally, utterly broken. There is a dream and hallucination about a new payment system that would presumably deliver that, so wait until 2017 and beyond if it's not failing like Mambo. But then you have a system that is architected and controlled by the 4 major banks. They will say who is allowed to access. By the way, Tyro was forgotten. We weren't invited. It's only full ADIs that are invited. That's another problem. The David Murray report talks about more a graduated approach, which is a very right point. You are either an ADI, so you take you're a transaction bank, you take deposit and you advance cash, then you have access to the system. If as a new startup, you will not be able to start on all this. If you do not have all these from the starting point, which you want as a new startup, you will have entrust your access to your competitor, which is not a very cozy idea for people who contemplate to compete with the major banks. So the David Murray Financial Systems Inquiry, in my opinion, thank you, Kevin, rightly required a renewed effort. That's how I'm reading it. In my opinion, when I came to the country, I thought Australia was leading the regulatory agenda and was still up technologically. Now I think we are lagging it big time. Other jurisdictions have taken the lead. 8 EU countries, Canada and New Zealand, achieve very high card issue and acceptance with a very low or zero debit card interchange. It's time to introduce this here. The European Union is about to extend the 20 and 30 basis points cap on all credit and debit card across the entire European economic area. So we were talking about what type of regulator? It's a skillful, engaged regulator who avoids abusive, protects the stability of the system, but enables competition. That requires a graduate approach, because peer-to-peer lending, no clue. Now, in my business, they know. So that would be easier to architect. Now, I think the country is at a crossroad. You know, if we are not being successful this year, next year, in the real near future, to open up our banking system, then Australia will lose, and the big banks, by the way, will lose. I'm not very clever, but I'm thinking banking, the institutional regulatory model, is moving to a software and data model. And if we protect our $30 billion cozy net profit per year bastion, all it means is some CEOs will still retire, famously, but we have sold our future to the new global players who got it. And banking, I know it's fragmented, it's regulated, it's complicated, I'm a victim of it. It will globalize and open up, and it will be faster than you think. So for the regulator and for this action that has to follow now, this is really critical. Thank you to be a little bit critical there.
Thank you so much, Jost. I think in our theme of engagement, what you've certainly demonstrated there is we have the issue about whether we have an engaged regulator may be moot, but we certainly have an engaged oligopoly in their efforts to defend their present profit pool. And some excellent points there that I would pick up as a professional investor. In particular, I think when you do have a $30 billion profit pool, one has to ask the question, what is in the best interest of the country in terms of how that is deployed against genuinely innovative programs? Backing for startups. I've been very loosely involved, mainly as a spectator, with the Committee for Sydney efforts around fintech, and I know Jost Stormann has, through Tyro, actually been establishing some parallel efforts to stimulate the growth of new companies. And I thought it'd be great if we could segue from that thought into perhaps some input from Ben and Ian around the data aspect of things and this real, shall we say, pregnant opportunity facing the country around this very large profit pool we have in financial services, but deploying that in a much more outward-looking fashion to develop businesses that can compete globally and really own the stage, as it were, in building some great new employment, profits and taxes, shall I say, for the community. So with that in mind, let me perhaps give a little bit of introduction for Ben and Ian in the context of Belinda's remarks about HFT. I can well remember, I love the taxi analogy for HFT. You can easily get run over in the New York markets. You can get run over by a cab. You could get accosted by a crazy person in a bar, but you could also get run over on the New York Stock Exchange or indeed any other market venue. And what I found particularly interesting about that period was at that time, I actually was leading quant research for a major US firm, and I'd contrast the response of US companies to Australian companies in this particular area. So when HFT really started to grow and dominate the shape of markets in the US, for whatever reason, whether it's Reg NMS or just good old-fashioned Yankee competition, you got to a stage around 2006 where at that time I was working for a US firm, AllianceBernstein. We had 4 major trading desks worldwide. In my particular area of responsibility, I was heading research for quant trading for those 4 trading desks, and we had the minor sum of $400 billion US in equities to invest globally, and we're doing hundreds of millions of shares a day trading. So we had an important problem to solve in terms of how we got the best results for our clients in deploying that amount of capital in global markets. And the US solution for what was, frankly, a somewhat conservative firm was, why don't we try and understand this high-frequency trading thing, number one. Number two, let's understand where we might have some skill gaps that we need to close and hire against that. And number three, start small, experiment, and figure out if we can't play this game ourselves, which is exactly what we did. And that was what happened in the US. In Australia, having, I guess, returned to the Australian markets, and Belinda mentioned, I think she did full credit to her own role in terms of keeping the warring parties apart, in bringing some calm to this notion that, hey, robots might actually do things that people used to do. Get over it. And then work with it and try and see how that might make your own life better. Now, the interesting thing was that for a lot of Australian firms, they didn't engage with that technology. And I think that's a terrible shame because, as we'll hear shortly from Ian and Ben, there is actually some terrific investment opportunities in developing firms that process this data. And I to my great dismay, I actually wrote 9 separate letters to the AFR describing the benefits of engagement with the technologies of HFT in spillover businesses of many different varieties that all represent terrific investment opportunities, and not one of those letters was published because there was a very vocal community in Australia from funds managers saying, we don't want to do anything different from what we've done before. And yet I had direct experience of the US response, which was, hell, throw that idea out. This is competition. If we don't step up, we die. So we'll step up and conquer. And I think that that attitude is sadly lacking at this stage in the Australian financial services community. So I fully endorse Jost's, shall we say, plea that we get a little bit more engaged in our own businesses in shaping the future. So without further ado, I'd love to hear from Ian Upperman, because people will not appreciate that at the same time the HFT debate was going on, just down the road in the rocks, Australia had built the world's best global database of securities, tick by tick, anywhere on planet Earth. So let's hear it from Ian.
Thanks very much. So I'm Ian Upperman from Rosetta Technology. We're the company you've never heard of. We are the financial spin-out, of commercial spin-out of a company called Circa, who many of you probably have heard of. It's interesting, I am going to talk a little bit about data, but I'm a real technology fan, and I believe that once you get into a role or start looking at challenges which are either dull, dirty or dangerous, then robots are a great choice. Once you go beyond the human capacity to respond or the human capacity to understand, then it doesn't matter whether things are trading at millisecond rate or microsecond rate or nanosecond rate. It's all the same. It's far too rapid for us to really intervene and do something about it, at least at the transactional level. Interestingly enough, my wife is a lawyer, in fact a barrister. I realised that when we got married that I would never win another argument, but it hasn't stopped me from having opinions. And one of the things that I argue strongly is that data, well, in the physical world, sunlight's a great disinfectant. In the world, the virtual world, the data-driven world, data itself is a great disinfectant. It's the sort of thing which can really expose, shed real light on some of the darker things that happen. It allows people to understand really what's going on as opposed to what they think is going on. And through my career, before joining Rosetta Technology, I was with CSIRO, Chief of Division, a lot of work in robotics, a lot of work in e-health, a lot of work in e-government, a lot of work looking to bring data-driven decision-making tools, or evidence-based decision-making tools to play. And before that, I was with a company called Nokia. They used to make mobile phones. They don't do that anymore. But I was on the unsexy side of the business, which was the networks business. And one of the things that happened in the networks business is it got a lot of competition. Every single country had more than one major mobile phone operator, and there was incredible pressure to innovate. So what happened is that we developed tools which originally started hypothesizing this is what the network should look like, but we developed tools that actually said, this is what's going on in the network. Pull all the data out of the network. Every single interaction, I have one of the last Nokias for anyone interested. Every single interaction this phone has with the network is something I can capture. Every interaction that I have with this device, I can capture. And I can use that to improve the quality of experience of that customer and how well the phone operates in the network. Then, of course, you can capture every part of the billing side of the network. So that's called the OSS, the Operation Support System. But then some really clever things started to happen in the billing side of the system. And the software behind billing is astronomical. It's huge, many, many, many hundreds of millions of lines of code. Far more than was ever used to launch a space shuttle, for example. And it allows things like this second-by-second billing, rating, charging of users. The network is doing a credit check on you every second to see whether or not your call can keep going for the next second. And that's for prepaid and for postpaid. And that sophistication allows things like the payment systems to happen in the Philippines. In fact, I was with Nokia long enough to actually see that start to happen. And people use phones in really innovative ways. We saw it in India, we saw it in sub-Saharan Africa, we saw it in different parts of Asia. But the whole point really is that you've got these incredibly powerful systems, and when combined, you know every interaction the user has with the phone has with the network, and that user has with the billing system. So that led to something called customer experience management. Take all of that data about every interaction with the network and then flip it on its head and make the user the center, and a whole new world was created where you could actually start to look at who are your highest earners, who are your highest spenders in the network, who are the ones you really wanted to keep, who are the ones that you would afford to churn, where you allocated your precious resources. And through my career, the combining of data has been something which is really powerful. An example from CSIRO in the healthcare system. If you think financial services are complex, you should look at the healthcare system. It's unbelievable. But using data, we're able to predict who was going to walk in the door today, tomorrow, next Tuesday, next October, with what sort of injuries. And you could do that and say there would be 4 people with trip and fall. There'd be someone coming in with a hip problem. You could predict that in 4-hour blocks, quite a long way into the future, by looking at the data for the hospital records itself, and then starting to bring together weather data, information about social events that were going on, information about pollen count. And it was absolutely amazing, the accuracy that you could predict what was going to happen. And the first trial of this happened to be during Schoolies Week, and it was the thing that happens on the Gold Coast with the Logan Hospital. And the results were just amazing in terms of how accurate, what sort of injuries. They wouldn't tell you the person, they wouldn't say it's David's son or daughter. It would say that 3 people will come in the next 4 hours with these sort of injuries. So the power there really was combining different data sets together and doing something which allowed much greater insight to be developed. So during the course of my career, I've learned a couple of things, apart from don't try and win an argument with a barrister. Data is really hard to get. Behind all of these systems, there are lots of different reasons why you can't get access to the data. Linking just the OSS and the BSS systems together was an incredible challenge, which required hundreds of people to work collaboratively to just to link 2 systems which are owned by an operator. There's lots of reasons why you can't do it. One of the examples in the healthcare system that is because so many documents are still used to capture data. So there's all sorts of reasons, the unwilling, unable, and in some cases the not allowed, which actually speaks to the regulatory situation. And there are lots of cultural challenges, there are legal challenges, there are regulatory challenges, and there are challenges associated with just getting stuff off paper in some cases. The other lesson is that data is powerful when you combine it. And the OSS-BSS example is a really interesting one. That unleashed hundreds of billions of dollars of value and created a brand new industry around customer experience management. The point, though, is that the more data you can bring to bear on a problem, the deeper insights you can get, or the more questions you could ask that you couldn't ask before. Who are my highest spenders? How many of my radio resources should I put into keeping that group as opposed to letting others churn? The other big lesson about data is that there's always a human in the loop somewhere. So I started by saying that with algorithmic trading or high-frequency trading, once you get beyond the human ability to respond, it doesn't matter whether it's nanosecond or whether it's microsecond or whether it's something even much higher frequency than that. But encoded in all those algorithms, there's someone's judgment. There's someone making a decision about what's good or bad. There's someone making a decision about what to do when something happens. So what we do as a company, what Rosetta does, the company you've hopefully now heard of, is that we manage large amounts of data. Historically, it's been market transaction data. We have the world's largest financial market database. One of our favourite customers came over to see us and said, we'd like a copy of the data. And we said, sure. Handed a memory stick. And we said, we'll cut you some hard drives. We've had someone we employed specifically to do this working since last September, cutting hard drives. We realised that we would fill the hold of a 747 with the data sets that we've got. So that's a lot of data. But we're now keeping data on property, on weather, on soil moisture, leaf wetness, temperature, humidity, on tectonic plate movement, on chaotic behaviour of nonlinear lasers. Because all of this is the sort of thing that, given your problem, or in fact, given your question, these are the sorts of data sets that you can bring to bear and really provide incredible insight as to what's going on in your market, where to put your next store, where do I build my next shop, when do I harvest my crops, or where was Australia 100 million years ago? All of these problems, whether they're markets-based, whether they're financial-based, whatever the case may be, can be informed by large amounts of data that you can bring to bear in a really powerful way. So we spend our time building tools that monitor, detect, report, identify, model, analyse, optimise, principally for financial markets. And these are the sort of tell me when, show me this, compare me to this, find another one like that. And these are really simple tools which provide really incredible insight for people who are still making decisions in what we call wetware. But they provide really powerful insight and give you a completely different perspective on things. And one of the great things about being Rosetta Technology, with the history we've got and the relationship we have with our customers, is that it's a really, really short period of time between we've had a good idea, one of our academic partners, one of our researchers, one of our staff has a good idea, to actually getting it in front of a customer. It's a really, really rapid turnaround. And I think, to your point earlier, this is a domain, this is an area where innovation is going to be incredibly disruptive. And when a small number of companies define the rules, where they rely on information asymmetry, they know more than you, therefore you go to them, that's absolutely ripe for disruption. And part of our job, I think, is to drive that disruption. We can create some real benefit, but we can also create some public good, because data is as the best disinfectant for people hiding in dark spaces.
Thank you, Ian. I wanted to bring in some of the other panellists. We've heard a lot about data, electronic trading, and so on. And Ben, I know that you know, in your whole enterprise, you're investing a range of these. I know Stuart is keen to use data in peer-to-peer lending, and of course Sandy really knows about disruption in the Silicon Valley community. So please, Ben, would you offer your thoughts about it?
Sure, thanks Kingsley. So picking up on a couple of ideas, AWI is a little business that's investing in early stage fintech businesses. So we've invested in I think 14 businesses, 11 of which are small early stage businesses across the spectrum. And the main reason we're doing that is to echo what Ian's just said. We think there is a disruption coming through financial services, which, to be honest, I don't think the big banks necessarily see coming. Maybe they do see it, but they're hanging on to what they've got for as long as they can hang on to that, which is going to be tectonic. It really will be much bigger than a lot of people perceive. I also think it'll happen much more quickly than people perceive, albeit that won't necessarily be this year or next year. So it'll take a little bit of time, but when it goes, it'll go with gusto. So you know, really bluntly, we think if we make a series of smart bets in little businesses in this space, we're half a chance that some of those will end up being very big businesses. There's a couple of themes that permeate the way we're thinking about the space and what we're seeing. The first of those is that a lot of the things we're seeing are about the customer experience. So, and by that I specifically mean the end customer experience. And that's a bit of a change, this idea, everyone's become all very gung-ho about fintech now. Now, half the people didn't know what it meant a year ago, but suddenly it is the business to be in. Now, fintech, financial services technology, has been around forever. A good, clever fintech's been going on, well, Tyro's been doing it for 11 years, and companies well before that have been doing it. It's just it's traditionally been more B2B fintech, you know,